Welcome, everybody. My name is Anat Dmati, and I'm the faculty director of the Corporation Society Initiative, CASI, which is sponsoring this event. I'm going to say very little today because we have yet another introducer. And the important thing about the introducer is that his name is Chanwoo Park. And he is one of our student leaders. So you should know that CASI is a collaboration of student, faculty, Lisa and Tina, and amazing student leaders. Some of our events come because of, class visits of some speakers or some other connections, and some of them come because students want them. And this one is Chanwoo's project. He wanted it. A few years ago, we had an event on student union, and it's because a student leader wanted that event. We made it happen. So that's the importance of this event, and I'll also say we have wonderful lecturers of the GSB who agreed to speak. The moderator was a CASI visitor himself a few years ago, and we had it in CEMEX, which we don't usually dare to do, with Bethany McLean, and it was a big hit. And it was called CSR, Corporate Social Responsibility, plus ESG equals BS ? So there you have it. I'm going to let Chanwoo introduce the panel. Thank you very much for coming.
I'm thrilled to see so many of you here. For what I know, it will be very insightful and thought-provoking discussion. So as a student leader at CASI, I propose tonight's theme because venture capital plays such a dominant role in shaping paths of both Stanford GSB founders and also VC investors coming from GSB. But often, we only hear about one side of the story, mostly happy and successful story of unicorns. But we mostly celebrate and commend VC for funding rounds and unicorns and then exit. But what about the trade-offs and the pressures and mostly responsibility that comes with deploying capital? How do we ensure that VC is not just about financial returns, but also about long-term value creation for society and most importantly for GSB students? Tonight, we have an incredible panel of experts who have navigated these questions firsthand as investors, founders, and educators. They bring diverse yet unique perspectives on the role of venture capital in driving innovation, its impact on people's lives, and how we can push this industry towards more positive outcomes. Our moderator, Tariq Fancy, is a successful investor and former CIO of sustainable investing at BlackRock, and he's renowned for his insights in merging sustainability with capitalism. Our panelist, Russell Siegelman, is a seasoned investor and beloved lecturer at Stanford GSB with decades of experience in technology, venture capital at Kleiner Perkins, and impact investing through the Global Innovation Fund. Lastly, Scott Brady is a managing partner at Innovation Endeavors, a seasoned entrepreneur who co-founded 3 publicly traded tech companies, and also beloved Stanford GSB lecturer known for investing in breakthrough technologies that disrupted industries. So from that, we'll start with Tariq Fancy.
So thanks everyone for coming here, and Chanwoo also for the initiative to spark this event. I'm going to try to recede into the shadows a little bit, but let me just say 1 or 2 things just to prime this. First, my background, as Anat mentioned, was at BlackRock and asking some of the tough questions that a capitalist needs to ask about how the system serves society in the broadest sense, right? Because markets serve society and not the other way around. And the VC industry is a particularly interesting one. First of all, I don't know a lot about it. I'm the only person not a VC up here. But it is on the surface an industry that is a lot easier for people to understand the value creation, right? These are new businesses, they're growing, they're creating jobs, and so on. And I think, as with any other industry, and certainly what I've seen in the financial markets, you tend to have sometimes a bit of a gap between the perception of what people think something is and the reality. And that can move on different vectors, right? So for the VC industry, misconceptions and truths about what it is to actually be VC, right? For a lot of people here wondering what that's like. The second major area is as a founder, right? Who may interact with VCs and take funding. I think the third broad question is for society, right? Because the tech sector has obviously grown massively in importance in the last few decades and has a significant influence on government and society now in a way that leads to a bunch of interesting questions. But to start with the first area, I thought we'd just kick it off by talking a little bit about the misconceptions people tend to have, particularly in a business school environment, about what it is to actually be a VC. You know, what does that entail for those who are looking to do it or certainly try to understand a bit more of the industry? Russ, I thought I'd pass the mic over to you first. I know when we first met, you had some really interesting thoughts about having, as with Scott, being on faculty for a while and having seen sort of the starting point a lot of students come in, where what they think it is and then what it actually turns out to be. What, in your sense, are the broadest misconceptions people have in that area?
Well, first, thanks for having me. This is fun. I don't talk about the venture capital industry that often, but I think about it a bunch. And I want to just preface my comments by saying I'm going to have a little bit of a contra take, maybe, than some of your views on VC and maybe Scott's, I don't know. But I also want to say, like, I'm not against the venture capital industry. I was one, and I think there's a lot of fine people doing reasonable things in the venture capital industry. So some of my critiques might sound strong, but I'm not trying to impugn anybody who does it. And for some people, it might be a great career. So what I hear a lot from students, because I was one and maybe because people have heard that maybe I'm not a huge fan sometimes, I get a lot of students asking me, well, what's it like being a venture capitalist? And I would say there's sort of like 3 or 4 things I hear from them that I think, at least in my experience, really don't align with what they really do. So the first is I hear from a lot of students, oh, I'm really analytical and this job requires a lot of analytics and I'm going to be really good at it as a result and I'm going to love it. And again, there's different kinds of venture capital, but if you're talking about the really early stage venture capital, which is what I did, I would say analytical skills are maybe useful, but not really the job, right? Because there's not a lot of data to analyze. I mean, and people say, oh, you know, I'm really smart. I can figure out industries and I can see future trends. And I can tell you that's not really what venture capitalists do. They might say that, but I think the truth is, if you just look at the failure rate, if you look at, I mean, like I would tell you every year we would have 1 or 2 offsites at Kleiner and the best brains would get up on the whiteboard and say, here's the trends we expect. But if the next week an entrepreneur shows up and has something completely different than any of your trends, but the plan looks really good and the entrepreneur looks really good, your trends go out the window. So again, I think there's this notion that you know analytics and like understanding industries and all this stuff, that's what I'm going to do. And the reality is, I mean, you do some of that, but that's not really a lot of what you do. What you do a lot of, and this is, again, maybe it's a great fit for some people. It wasn't particularly a great fit for me, is the really good venture capitalists, they spend a lot of time meeting people, frankly. It's a networking job. And again, this is going to sound like a strong critique, but I think a lot of venture capital investing is kind of considered gambling. I mean, they know they're going to have a big failure rate. So they're tossing the dice a lot. And one of the only ways to improve your likelihood of success in the venture capital industry is meeting really good entrepreneurs and getting them to take your money. So having a great reputation, being out to, having a public face, all these things. I mean, those are the things that really matter, not analytical skills. So, I mean, those are a couple things I mentioned. And I would just say one more thing, which is sometimes I hear people, and again, this is going to sound a little distasteful, but like I hear students say, it's a way to make a lot of money. Sure it is, but there are a lot of ways to make money in the world. And so I would suggest it's not necessarily the best way. Like I think if you want to get super rich, start your own company and make it super successful. That's the way to make a lot of money anywhere, let alone in Silicon Valley for sure. So I guess my attitude about when I hear from students, I want to be a venture capitalist, I just want them to understand like what they're getting into may not be the job description they have in their mind.
Yeah, it makes a lot of sense. I remember doing banking interviews. People would try every way they could to not say they want to make a lot of money, even though that's probably why they were in the room. So it leads to an interesting conversation. Scott, what's your sense? Would you say you sort of land the same way? Or, I mean, I know it's a big industry, right? So one of the things you said at the beginning is that it's hard to generalize, because it'd be kind of like saying private credit is this, or private equity is this. So what's your sense of kind of how you view that?
This feels like an AA meeting for investors. So just maybe a bit of context. So I spent the vast majority of my career as an operator, raised almost $1 billion as an entrepreneur, did a number of companies, and got to see the other side of investing. Got to meet many investors, got to see different personas, different firms, different stages. The reality was there were a very small handful of investors I had that were extraordinarily impactful. They were great. They offered more than capital, they offered insight, they offered ways to help me make original mistakes as an entrepreneur, and I remember that. I remember them being incredibly impactful and believing that was, at least for me, the blueprint of what I thought great investors should look like. The other thing that I respected was that the best investors recognized that they weren't the hero of the story. The hero of the story is the person that does the extraordinary difficult thing, that quits a good job, does something that is unexpected, does something that likely may not work. So there's, I think, a tremendous amount of respect that you have to have when you do this. So when I started working when Eric was CEO of Google and Jor was actually one of his students and the firm was getting formed, what I found attractive about this, and quite frankly, a few questions I had to ask was, first it was, how do we intersect with extraordinary people that are trying to solve the hardest problems? That's not necessarily that's predicated on how do we make the most money. It was, what are the things that are worth doing? How do you get the best people working on the things that we as a society or we as industry need to happen? And that really, first off, comes from a position of a prepared mind, and it comes from a position of being able to intersect with them with empathy in terms of where they are. The second thing, which was really hard for me, having been an operator for so long, I wasn't sure that I could have the same passion for the companies that I was funding as I did when I was building them. And much to my surprise, I found that there really was a transitive property. I found that I could become as invested in the companies that we're working with. And really, although recognizing I'm in a very different position, I'm not in the trenches, but I'm with them. I'm as emotionally connected to those companies as I was when I was building companies. So, partially when we set up our fund, a lot of the time was spent on culture. It was spent on making sure that you're bringing value to the equation, making sure you have a prepared mind. So maybe a little different than what Russ was saying is a lot of our work is very thematic. It's very research centric, where we are thinking about the intersection of computer science and thinking about how industries are going to be disrupted and change, and really get to the core of what are the things that are going to exist in the future. In order to do that, you have to meet the people that are at the core of making those decisions and listen. You've got to add value, you've got to be present, you've got to understand, at this nexus of where things are happening, how value and how capital can actually be supportive. And I think we've found that we're at our best, and quite frankly, I think venture capital is at its best when you're really catalytic capital. You're there to help extraordinary things happen and then really support the people that have a profound vision to do something that's very, very difficult. So I had a lot of investors that weren't like that. I had a lot of investors that, quite frankly, caused more friction than they created value. And, I think on measure, as I got better at it, I spent more time being thoughtful about who I would take capital from, because I knew better questions to ask. And quite frankly, as I became more successful, I had more choice. I had the ability to have not just one choice, but have many choices that I could choose from. So I think as we dive into this, I can share with you insights that I've sort of gained along the way and maybe help you make a few original mistakes, either as you consider being an investor or taking capital from venture capital.
Well, that's great. I mean, one question I think that might be worth digging into a bit is, the sort of, when you mentioned some of these investors had more trouble than they're worth almost. Obviously, for any student looking to get funding, you're not going to have that many options at the beginning. But obviously, without naming names, what are the patterns you found with respect to the ones, for example, some of them will have a great brand, and that gets them in the door, but then often it comes down to the specific personality, or do they have a thematic background or focus? So what are the sort of things you came out with after learning that some of those investors weren't as constructive as you hoped and thought, well, I wish I knew that before?
I don't think choosing an investor is that different than hiring great people or building a team. I think the reality is the best predictor of how someone's going to respond in the future is what they've done in the past. So referencing is critical, being able to actually dive in and ask questions, how does this investor respond when things are going well? And how do they respond when things are not going well? Are they collaborative? Do they step in? What's the playbook they're going to play from? Likely, you're not going to be the one to change the philosophy of a firm. If they normally have a way of reacting in specific situations, you're not, you're next. It's not you. You're not going to avoid it. So I think when I became better at this, I spent more time thinking about the who. And I mean the who in terms of the person I'm going to be working with. So the mistakes that I see investors make or I see young entrepreneurs make is they assume that the highest valuation is the best thing. That is rarely the case. They assume that the brand of the firm is more important than the person you're choosing. That is not true. If you happen to get the best person at the best firm, good for you. But the reality is this is about the person you're going to build a relationship with that could last, in some of the companies I'm involved in, can last more than a decade. So being very thoughtful and very process-oriented and hopefully giving yourself optionality in terms of who you get to choose from is really critical. And then good process, having an understanding of what are the things that matter in a negotiation. These are all things that hopefully through the privilege you have of being here, you likely are better situated to make good choices than the average person that is meeting venture capital for the first time.
Super interesting. I mean, so let me ask a slightly different question. I come from a more contrarian investment background, and one of the things I've always found interesting is that the VC sector seems to have a bit of a herd mentality. That's the reputation of it. Number one, I'm curious, how much do you think that's true? And number two, how much does that create a difficult trade-off against what you were just mentioning, in the sense that you maybe want a certain VC who really understands you, they were an entrepreneur, they really get it, but along comes big name player and a really big valuation, and it becomes very difficult to ignore that, because that could get your round done.
You want to answer that?
Sure. I mean, I think I don't think you have to look beyond the data to see that there is in fact a herding mentality. As areas get more interesting, just plop AI in front of anything right now, and it's a massive herding mentality, when in fact the vast majority of people don't really understand the nature of how value gets created. So I come at this from an early stage, very technical firm. It does work at the edge of computational biology and software and so forth. So a lot of our work is really anticipating. It's meeting the people that are in fact the change vectors in these industries that have what we think are disruptive capabilities. In order to intersect at that point in time, it's inherently early. So it's very talent-centric. It's not herding-centric. It's that in this domain, we believe that there's going to be a change vector here, and we want to be able to find the best experts there, because that's how we think industries are going to be disrupted. So it's hard. You can't herd if you're sitting looking at the point of the spear. The hard part is, how do you choose the right talent that you're going to be investing in? If what we see in these markets is that when you're early in it, you get a lot of capital that wants to follow into the work that you've done. So there's a tailwind many of the times that this happens. But the challenge is that depending on the stage that you're investing at, these valuations get completely unrealistic. It's impossible to generate venture returns. If you actually sit and look at the math in some of these valuations, the entry point valuations you're getting into, the ownership that you can have in the company, there is no way you can ever generate venture returns. So I think disciplined investors tend to step back. They recognize when a market gets hot, You either got in at the right time or you have to step back and let the market ride for a little bit. And that happened for us, for example. Our fourth fund, our normal investment period is probably 2.5 to 3 years. And our investment period for our fourth fund was almost 3.5 years. There was a time in the market where we felt like we couldn't ethically deploy capital because the valuations made no sense. So we sat out. And it's hard. Your job is to invest capital. It's hard to sit back, but when you bring things into I think a disciplined investment process, when you're looking at some of the economics that exist there, no rational person can make that investment. Because ultimately you got to pay it back. There's a bunch of, I think about the people who give us capital. These are pension funds, they're endowments. These are people that we take very seriously the fact that our job is to take that capital and give it back, with a great return. So I think in these markets, if you're not at the right stage, I don't know how you can deploy capital comfortably.
Let me make a couple comments about that, because I agree with everything Scott just said, but I guess what I've seen in many venture capital cycles, because they tend to go in these cycles where the markets are up and lots of capital flows in and then it goes down. And so, but when you're riding up, there might be a few disciplined investors like Scott, but that's not what the industry does. The industry, I'll tell you, because when we were in the middle, I started in '96. So within the first year that I was a venture capitalist, it was the dot-com bubble. I mean, I saw the very first really big ride up. And every day in our partner meetings, we asked ourselves, when is it going to turn over? We know it's going to happen eventually. But until you see any reason to think that, you keep investing. Because that's the game. Remember, you have a lot of capital to deploy. Again, funds are different size and so forth. But generally, these days, there's so much venture capital money flowing in, and LPs want you to spend it. And if everybody's investing and valuations are going up, you do it. Now, we also had another saying, because you ride them up, but and some of them will make money, and then when you go over the top, you lose some. But you know what? That's the game. That is the game. That is the venture capital game. You keep investing and gambling until, you take a seat, when the music stops. Again, I don't think it's all bad, but I think the question I want to ask is, you will hear from some people in the venture industry and other financial markets that, the venture capital industry is the best way to allocate money for new innovations. And given this dynamic that Scott laid out very well, that basically when valuations go up and there's too much capital, is it really good capital allocation? I would argue it's not. If 70% of these deals fail to have any return at all, is that really good capital allocation? Now, I'm not saying I don't have a magic formula for better capital allocation. So maybe it's the best of the bad systems, but I would argue it's not what it's sometimes made out to be when it comes to capital allocation. And I also think this is another thing. When I get some students who want to raise money from venture capital, and they think, and this is not just students. I've worked with a lot of entrepreneurs over 30 years of doing this. And they'll have a party in their mind, or sometimes a real party, when they get that check, when some first-rate venture capitalist write them that check. And that's just a big confusion. That investor, that check is no validation of any success. Yeah, it's a validation of maybe you're an interesting entrepreneur, maybe it's an interesting plan, maybe, like Scott said, it's a really hot area that you're starting a company in. But you don't have any success validation when you just get a check from a venture capitalist. They're just writing a check, that's what they do. They're hoping you're going to succeed, but 70% of the time, they're expecting you're not.
Right. Well, I guess the hardest part is if you've never gotten the funding, then the first time you get it. Imagine Scott, so you've co-founded 3 businesses. The third time you got that check, it's presumably less exciting than the first. Yeah. Right, because the problem is, it's a bit easy to say, yeah, you could be choosy with your with who you take money from. Right? It's a bit like telling MBA students, hey, listen, you get a bunch of offers at when you graduate and then figure one out. But in practice, I think a lot of folks will be just focused on getting that one. When you look at the sector and talk about sort of pulling back, the question I was wondering is, are firms thoughtful about the different sectors, or in the sense that you could pull back from AI and still do a whole bunch of other unloved sectors, either because it's green tech and it's out of fashion for a few years or something else? Do you find yourselves or the industry have tended to sort of have that, so there may not be as much discipline around the timing of the market, but at least with respect to certain areas that could be faddish?
Yeah, I mean, we're a bigger firm, so we have coverage across a number of areas. The likelihood that everything is ebbing and flowing at the same time is likely not the case. Even if there's, let's say, common technology across a lot of these different industries, there's still very different dynamics in the industry. So, I think it's very challenging for firms that are sort of one-dimensional. They do one thing. Maybe they're very, very focused. And unfortunately, if they're in favor, they're doing well. And if they're out of favor, they probably are still deploying capital when they probably shouldn't. So I think, when you have a purview of looking across different areas, you're always competing for capital in a firm. So you're looking at, what's the likelihood of this being disruptive? What's the opportunity if we're successful? What's the cost of capital we have to deploy? And what's the quality of the entrepreneur that we're dealing with? And that doesn't happen in a vacuum. It happens in a competitive environment. And you're not just competing for capital for the first dollar. You're competing for follow-on capital, that's going to support your business as you grow. So, good VCs are making decisions all the time, and we have limited capital. How do we make sure that we're investing that capital in a way that maximizes value? Which doesn't, to Russ's point, doesn't mean that it's not democratized, it's not socialism. We're not trying to peanut butter the capital across people we have. We're trying to make hard decisions based on how companies have performed and whether or not this is the best and highest use of that capital. We may be a little bit different as a firm because the partners in our fund represent the largest LP in our fund. So we invest our own capital and allow other people to invest alongside us. So that, I think, creates a different philosophical element for how we think about deploying capital. It's not a faceless person, it's us. When we're agreeing to do it, I'm committing to do it, or my partners are committing to do it. So, but I think that competition is very healthy in a firm.
And then one other thing I was going to ask, in terms of the sort of daily work you're doing, Russ, you were kind of mentioning it, talking to a lot of people. And in a sense, it's not a little bit like deal flow, right? It's market understanding and it's deal flow. Is that what would you say is the biggest challenge for a VC in terms of building a business and driving returns? Is it ultimately deal flow, or?
Well, again, I don't want to sound cynical, but in my experience, the venture capitalists I knew of my era, and some of them are still out there, I don't want to name names, but that were really good, had incredible returns, they just, the best entrepreneurs gravitated to them because they had some early wins, because they had big personas, whatever. And if you didn't get those, you may have a hit once in a while, you might be lucky, but for the most part, that was the reason that those people separated from the pack. And frankly, there's another thing, more shots on goal. As a junior venture capitalist, I can only do a few deals, whereas I was dealing in a firm with partners. Some partners did 5x mine. Well, more shots on goal, you're gonna have a higher hit rate. Right. So I think there's just a bit of that. But let me just say one more thing for students or anybody who's thinking about being a venture capitalist and maybe not understand kind of this dynamic, because again, I was an operator too. I was at Microsoft for 7 years as an executive before I became a venture capitalist. And what I loved about my job was working with people, building products, shipping products, working on a team, making lots of decisions. All of those things, you don't really do that often as a venture capitalist, right? Like, you're not managing a team. You don't really make decisions. You decide to invest maybe 1, 2, 3 deals a year. And by the way, you don't do that unilaterally. You usually do that with a partnership group that weighs in. And then what do you do after that? You sit back maybe 5, 7, 10 years, like Scott said, to see what happens. You don't really make any, so, I would say like students who come to me and say, I shipped this great product in a tech company, and now I want to be a venture capitalist. I say, I did that, and you know what? It's completely different. It's just a whole different way of operating. I mean, the investor mindset, and Scott has very well articulated some of the things you have to do as an investor. It was, to me, very antithetical to being an operator. Very antithetical.
And Scott, has your experience been similar? I know this is to the point of the industry is very different, so you may be in sort of potentially earlier stage and more technically oriented. So did you find that a bit more was that sort of analysis versus the deal flow component?
I mean, I think you have to have an opinion. Otherwise, if you don't have a prepared mind, it's very difficult to go meet with people because you don't, you're not necessarily meeting the right people. You don't have context for what they're doing. So I think you have to meet people where they are, and part of that is you have to be prepared in order to do it. And in order to be prepared, you have to be disciplined about how you go attack the market. So likely those people are not going to come knock on your door, at least not at the stages that we're seeing them. You've got to go see them in the wild, if you will, and sort of catch them where they are. But maybe just to double click on one of Russ's points. I mean, I'll be very honest. I mean, I loved building companies. And honestly, the attraction of coming to work with Eric here was that I could work with many, many more companies than I could individually. So, if you think about it, venture capital is like 60 days of craziness and then 10 years of hard work. This is, being in the trenches, side by side, building companies is incredibly difficult. Watching the ups and downs, perturbations that these companies have to go through. I mean, I sit on, I think, 12 or 13 boards now, and I chair typically the engineering subcommittee in almost every company that I'm involved in. When you're down at the bare metal of what's happening, I think it's one, that's the part I like. Two, you realize how difficult this is to do. How much has to go right for you to be successful as an operator, but how fulfilling it is when it does. So, I think when students come to talk to me about wanting to be an investor, I'm not sure I'm the right advocate. I think I've gotten much more joy out of building companies. And then really the joy out of being an investor is just observing people do really extraordinary things. So I think if you want that first party feeling, you can only do that by being an operator.
Yeah, I agree with that. And again, maybe just my experience was like, I also tried to sit on those engineering committees and because I had been a software developer and run technical products at Microsoft. And I found it incredibly frustrating because what I found out was like, if the team wasn't doing well, my job wasn't to sit there and tell them what to do. My job was to fire them or get the CEO to fire them. And if the CEO didn't do it, then I had to fire the CEO. And so like, again, my scope of responsibility and my scope of value add was so narrowed compared to when I was at Microsoft and I had 350 people working for me. Like, I had all the scope of a manager, which is quite different than being the scope of an investor. So again, I'm not saying it's good or bad, but this is one of the myths. I want people who think they're going to operate in the venture capital role as a manager, as an operator, as you might be trained here at a school like the GSB. I think it's just very different.
Yeah, I think if you think about your role as a fiduciary, probably one of the best articles you can read is Mike Volpe, who formerly with Index, wrote an article about what does it mean to be a good board member. And if you think about that, to exactly what Russ said, this is unlike being an operator. Your job is not to tell anybody what to do. Your job, if you look at what Mike talked about, it's to be able to step back from a team, look at the recommendations and decisions that they're making, not by critiquing the decision, but by looking at the data that went into making that decision. To really think about what was the rubric they used and what's the wisdom that went into making that decision. But at the end, you cannot break the accountability responsibility barrier. If you're going to hold a team accountable, they have to be responsible for making that decision. And the second you break that third wall, you break that accountability. So when you see great, board members, and I had a number of really good ones, you recognize that they very much understand the role that they play in that process. And that's not always true amongst investors.
Here, and I think he said it super well. And to me, this is something that's hard for, I think, for me to sometimes communicate. That third wall that you can't break, that's what being an investor is. The really good investors, they don't go over that line. And that's what you have to understand. If you want to be a really good investor, you have to have that distance. And again, maybe some people are great at that. For me, I wasn't. I wanted to be on the team. I wanted to feel the enthusiasm of making the stuff happen. And I had to constantly step back and say, like Scott said, are these people doing their job? And if not, I can't do their job for them. I need to take a different approach. So just understanding that is, again, one of the, I would say, myths that students have about venture capital.
It almost feels like you want to play the game, but you're on the sidelines, right? You're the coach, you can make decisions, but you can't run on the field.
Yeah, and it's almost more than that. Like you have to not even direct the players. You just have to say, wrong player, put a new player in.
I think the best board members, the best investors I had, allowed me to see around corners. They're the ones that could leverage the experience they had, the networks they had, to talk to me, to listen to what I was thinking, give me critical feedback in ways that allowed me to make better decisions. That is very different than managing a team. That's very much about meeting an entrepreneur where they are and trying to bring perspective to the types of feedback that you're actually giving. But it's a very nuanced set of skills, and there are a small handful of people that are really extraordinary at that, and a lot of people that are, quite frankly, really bad at it.
So let's switch gears for a second and kind of move to the perspective of the founder taking capital. We've touched on that a little bit, but one question is, are there recent trends or clauses or anything going on in the market that this is a great chance to highlight it to a group of students who might look at taking funding soon, that they ought to be sort of on the lookout for?
I'll start with one, and I'm sure Scott has plenty. So when I first got to Kleiner, there was an adage going around in the venture industry, and I suspect it still is out there, although I don't hear it that often, which is if you're raising money and you're offered more from A versus B, always take more. Always take more money. And of course, when I was a venture capitalist, like in the dot-com, one year we went up to $100 billion. It was incredible. Like we were looking around thinking like, there isn't $100 billion worth of good opportunities. Like we knew half of that was gonna got sunk. Because we had gone from like maybe $25 billion a year to $100 billion in 2 years. So we knew that was like half of that was just gonna be a waste. Now there's what? 150, 200 billion a year? I know it's crazy amounts of money. So we know a lot of it's not going to be used. But my point is, because there's so many capital flows now, the huge capital flows, you will be asked to take more money than you need. And my first thing for you, if you want to guard your equity value and preserve your job, is do not take more money than you need. And what do I mean by that is the amount of money you should raise is commensurate with your finest point business plan, and not a dime more. Because if you raise more, and it'll be thrown at you just because of the amount of capital in the industry, what goes with that? Expectations to spend it, and not just spend it, but spend it wisely. And if you can't spend it wisely, what happens? The first person who gets fired is your VP of sales, and the second person who's fired is you. That's just how it goes. I've seen it 100 times. And I would say it's really funny because, again, some people who are young, first-time entrepreneurs who come to Silicon Valley and they get validated by a venture capital check, and they say more is better, they get a big check, and then 2 years later they come back and they say, why did my company fail, or why did I get fired? Which they usually happen at the same time. I mean, there might be a lot of reasons, but one of the reasons is because you raised money when you couldn't use it profitably. And I think that's one of the core issues for all people who are thinking about raising venture capital. Look, I'm not against venture capital. If you are the kind of company that has huge market potential and needs a lot of capital, you are for venture capital, because that's what they're for. But if you are not that kind of company, and venture capital funds 1% of all companies in this country, 1%.
I think it's less than that.
Yeah, it's even less than that, but it's a small fraction. Now, The reason is because most of them don't have that market opportunity. And I would argue even of the 1%, there's a lot who don't. And even of the 1% that might have interesting markets, you don't raise the money until you have proof that you can actually spend the money profitably. So that's one big disconnect I see. And again, remember, venture capitalists, they have huge amounts of capital, they have to spend it. So they're not looking out for you saying, make sure you're going to preserve your equity and you're not going to get fired, just take enough money. They'll be like, oh, it looks like I won't name names. I heard I'm an investor in a company that's doing super well. He was in one of these classes recently, and one of the big time VCs who has a giant fund went up to him after and said, I really like your pitch, but I don't think you're thinking big enough. You're talking about raising 3 million. You should be raising 15 or 20 million. And the guy called me and I was like, dude, do not go there.
So one quick question. In terms of raising money and not taking more than you need, I have to ask this question. In February 2025, is that advice the same as it would have been 6 months ago?
Well, sure. I mean, there's always a question of like, if you think capital flows are going to go down and you're going to need more money, sure, there's some judicious thinking there, for sure. But generally speaking, when people are raising money, I think there's a tendency that more money is better. And I just think that's just a mistake.
What leads to spending savings?
I have to agree. I mean, I've some of the most egregious things I've seen were companies that were massively overcapitalized. And mind you, when somebody gives you that money, they don't want it to sit in your bank account. They'd prefer for it to sit in their bank account. So the second they give it to you, there's an expectation you're going to be using it. And I've seen companies try and scale way too early, make massive mistakes, completely ruin the culture of a company, largely not because they had a bad business, but because they tried to scale the business at a rate that was not appropriate for their current stage because they got access to capital. And a couple of companies I cared very deeply about that became massively overcapitalized. And I don't have a single example where maybe I have one. The company that I did, my last one, was the highest funded private company in the US before it went public. But it was very different. We raised the capital after we had really strong product market fit. And the capital, every dollar we deployed, generated revenue. We had contracts. It was back, more when growth capital was actually to fund growth, where we were deploying $30 to $40 million a month in capital, but it was all generating revenue. I've seen really bad hygiene happen when companies get overcapitalized. And I wish I could give you a good story for it, but I actually don't have a good one.
Yeah, but I think the key insight is to realize that venture capitalists don't have that discipline per se, right? Because some do. But a lot of them, they have a lot of money to spend. And if they think that giving you money will accelerate the outcome, they're very happy to try.
Well, in terms of even capital raising, this kind of leads to an interesting side question, which is, there's an article in Bloomberg a week or two ago that said that one of the challenges with the VC space in the US is actually that capital raising is being so easy that people believe that's the moat. And I thought it was interesting as a dot-com banker here many years ago, that having done work in China, to see that there was very frugal innovation. I think you know where I'm going with this. When we talk about those large amounts of money being raised almost on spec, it's hard not for the AI space to come to mind. And I'm just curious, do you have thoughts on sort of where we are right now in that cycle? And I think also what that might do to the rest of the sector. Because if it turns out that it stumbles, and I started in 2001 as a dot-com banker down the street for Quattrone. So I've never even gotten the party. I got the hangover. So I have to ask that question. Where do you think things go next, and what's the outlook for the sector broadly, even for people not doing?
I mean, I think we are in, and I don't think this is being hyperbolic, I think we're in probably the most important disruptive time in my lifetime. I've never experienced technology that has the capability of doing some of the things that we're capable of doing now. It will impact every single aspect of business, of life. I mean, it's just, I don't think it's hyperbolic to say that. That being said, there's a lack of discipline. There's just an over exuberance that's occurring right now where there are some businesses, particularly some of the early foundation model companies, that were very capital intensive. In order to produce the models, it was costing a huge amount of money, and the revenue models for those are still somewhat unsure. Even companies that are very highly capitalized are not cash flow positive, so you're seeing a lot of capital that's still funding the potential of what these things can do. But I don't think that should take away from the actual opportunity. I think I gave a talk yesterday, and I think I could see the first $100 trillion company being created. I think there's an opportunity to do things that these companies will be the most powerful, I don't know, almost inconceivably capable in terms of what they can do. And I think that probably is in my lifetime. I don't think that's extraordinary. So I think not being part of this, is not a time where you can assume if I do nothing, nothing is going to happen. You should assume that many things are going to happen. That means if you're running a company, if you're thinking about starting a company, if you're sitting in grad school, you have to think about how to have a prepared mind to do that. So while I'm, disappointed by some of the inefficiencies that are happening, I don't think that in any way takes away from what I think is the opportunity right now. Like, I can't imagine a better time for those of you that are sitting here at Stanford about to enter the world. I wish I was 30 years younger. This is just an epic, it's an epic time. My wife and my partners would say otherwise.
Well, I tend to agree with this whole view of AI is going to change everything. I mean, not everything, but it'll change a lot of things. But I guess the one thing again, a little bit counter, I don't think it's going to happen as fast as people think. I have seen this technology adoption cycle like 5 times. I mean, when I was at Microsoft, you were talking about like pre-1996, which is when I moved here. We had a whole plan for putting all the server technology that was currently on kind of desktops and putting it in the cloud. And now it took 25 years to do that. And it's not like there wasn't technology. It was, you needed infrastructure, like you needed broadband, you needed companies to change their business practices, you need consumers to wire their homes and change their behaviors. All of this stuff just takes time. So the only thing I would say to people who are like, I want to get in the AI gold rush, is that you take your time. You can start now, but you don't have to feel like tomorrow I have a winner. And my son is in the AI world, and keeps sending me these texts saying, I feel like I'm missing out. I'm fear of missing out. And I keep telling him, don't worry. This is going to happen for 50 years. And it won't, and the really big companies, the $100 trillion companies, I actually, frankly, don't think it's going to be OpenAI. It's going to be the next wave of companies that really understand how to get these technologies diffused into people's and into corporations and create the value. Right now, it's fun. It's cool. I use ChatGPT every day. But is it creating a lot of economic value? Not yet.
Well, it's so interesting as the one former vulture investor at the table. I left the dot-com thing blowing up and then worked for Carl Icahn's chief CIO to buy up a lot of the assets, fiber optic cables, satellites. So I would joke to people that people usually mess up on the timing because they get so enamored of the technology, They assume it comes first. And so interestingly, then we were talking about the internet, right? So clearly it was. So let me ask one more quick follow-up question. So Scott, so long-term thesis is great, but the near term or the next year or two, that the $100 trillion company come, but do you think the next year or two will be a bit choppy in between? Or is it hard to say?
No, I think the direction is correct. The precision is low. I don't think anybody knows exactly which one is going to win, but we know directionally that we're moving, I think, way faster than we thought we would have moved. I think that lack of precision is going to create a lot of perturbations in the market. You're going to have companies that won in the first inning of the game. They got a bunch of capital and then realized they didn't have a good business model. So the aftermath of that is going to be painful. But that doesn't take away from the fact that there are going to be fundamental business models that are going to change. They're going to disrupt existing business models. And I think you can already see some of the early indications of where that's happening. I think you'll see things that will cure certain forms of cancer. You'll see things that will solve parts of energy. You'll see things that will change the way we think about you as an entity in terms of being able to canonicalize that. So there's a number of things that are happening right now that I think are things that are going to occur over the next decades, but they're going to be tremendously impactful.
Well, why don't we open it? Should we open it up for questions
Yeah.
now? Okay, well.
So as an operator of a company, how do you safeguard yourself against raising money from a bad VC, technically, right? So let's say if you put that VC in a preferred stock versus like a common stock structure, how do you avoid giving big money a board seat in your company?
Why do you want to avoid board seats?
Yeah.
Just for the operator interests.
I don't know if that's. I'm not sure I agree with the.
Yeah, I don't
your
agree
basic
with
hypothesis.
Yeah, me neither.
I mean, I think good governance is good governance.
Yeah.
It's why we're here.
Yeah.
Setting. Yeah, I mean,
That's bad. That was bad governance.
yeah. I think stepping back, I think the question of, maybe you're asking a question of how do you create a positive relationship with capital that supports value creation? I think it starts with, one, have a company where you have choice. Choice is critical. Choice is what gives you the opportunity to be thoughtful about who you take capital from. I think it's being knowledgeable. The best friend of an early stage entrepreneur is a good counsel. I get to do this. I do this a lot. Counsel does it 100 times more than I do, and you may get to do it once or twice. So having someone that can decode what is standard and what is good and help you avoid some of the really catastrophic terms that can end up in a term sheet are really critical. There are things that are coming back now that, from your Carl Icahn days, you'll remember. Things like liquidation preferences, participating preferreds, things that are really destructive because they create misalignment in the cap table. And you being able to understand the impact of some of those terms that are coming into a term sheet, and then understanding that in the calculus of who you choose to take capital from, is really critical. So you being knowledgeable in what you want in an investor and what you're willing to give up and do it, I think is good hygiene. And then I would say great boards are superpowers. Like if you can get people that are committed to helping you build a company and there's good hygiene around that board, I don't think there's a better force multiplier an entrepreneur can have than having those types of people committed to building their company.
I'm all in for good boards, so I'm 100% with that. But I guess like the big question you might be asking, but let me rephrase it in the way I think about it is, if you're going to take money from outside investors, yes, you're going to give up some control. That's just how it is. And if you don't like that, then don't take money from outside investors.
So let's say you make a bad decision and get a VC on your board, and like how do you file
Well,
that?
then you made a mistake. There's hardly no way to go back from that.
Yeah. You're making a long-term decision when you bring somebody on your cap table.
Sure. So, you've been at this game for 30 years, like me, but I've been on the other side of the field. And I like asking a VC, what was your involvement in a company? What's your ideal company that you invest in early on? And what's your involvement over the 10 years that follow that? And I'm guessing you guys will have different answers, but
I'm going to guess not. I mean, to me, the best companies I have are the ones that need me the least. Honestly, like it's the companies that execute well when you're not looking. They anticipate things that they need, so they're helping you, help them. I think if I were a better investor, I would spend less time on the things that need my time and more time trying to help the people that didn't ask. So
can I rephrase that? It's like the best investors, you give them capital, you let them run. For the best investments, I should say.
yeah, I think, the longer you invest, the more you come back to this basic tenet that we invest in people. It is extraordinary teams that do extraordinary things. And that means that those teams are resilient. They can recruit extraordinary people. They can overcome challenges. They can see around corners. That is the differentiator in doing extraordinarily hard things, is really the who that you're giving the capital to. And occasionally, and probably maybe more than occasionally, we don't always get that right.
I agree with most of everything Scott just said, but I guess slightly different twist, which is there's another adage that I used to hear about in the venture industry, or a little bit of quiz. Would you rather invest in an A team with a B plan or B market opportunity, or the reverse, like a really, really ripe market opportunity and maybe even a C team? I ask that of students a lot, and they would say, team. And I guarantee you, any skilled venture capitalist who's been around would say the reverse. I have seen companies make an incredible success, like mint money, and have C teams at the beginning. They hire good teams over time because the capital flows in. And the reverse, A team, C market, forget it. It's out. They'll waste money, they'll try, and it'll fail anyway. So yeah, you do back great people because you have to. But it's not enough. You've got to have a market opportunity that you hit at the right time with the right approach. And frankly, even some really, really good entrepreneurs don't always succeed as a result of that.
The term, I don't know if any of you if you've taken a class from Garth Saloner, but Garth always says when a great team meets a bad market, the market usually wins.
Yeah, that's right.
So yeah, in the context, you have to be right, and you got to be in the right place in order for this to work. So for it to be a true force multiplier.
Any questions on the third theme, VC and society? I wanted to make sure we touch on that. Go for it.
Yeah, thanks so much. That's probably the most honest conversation about the venture capital I was listening to in my life. So there is something that you mentioned multiple times, and it is that entrepreneur and venture capital, they have different incentives. And there is an opinion that this is basically causing this misalignment, right? So because one party needs one bat out of dozens to succeed, and Russell has been using the word game to describe that, while the other one, he doesn't have many options, right? So for entrepreneur, it's one thing that needs to succeed, at least for the next decade or so, right? Is there a way to bridge this gap? Because these people will always be having a very different goals, in fact, right? So what would you suggest? What would you
I mean, so he's pointing out that typically, I would say in almost all cases, the investor has a portfolio of bets. That's why they raise a lot of money and make multiple investments. And so they assume some of them are going to fail. But you as the entrepreneur, all your equity, all your time, all your energy, maybe all your net worth is tied up in the one that you're working on. So there's a difference of opinion there. Now, does that lead to really drastically different alignments? Maybe not if things are going well. Then both parties want it to be successful and we'll work together. The issue comes up with maybe when the entrepreneur wants to keep going and needs more capital, and the investor says, I'm not interested in this anymore. I don't think this is going to work. So there are times when the interests align, but sometimes not. And you have to be mindful of that as an entrepreneur. I think that's one of the big, myths or sort of not fully aware things, I would say, that entrepreneurs get into when they raise money from venture capitalists. How you better align, you succeed. Like Mark Zuckerberg had no issues with misalignment with his investors.
Well, he had for a couple of years at least. When he was raising Series B before that, so it was a hard time for him.
Yeah, if you know the detailed history, yes. So there was a time when he wasn't quite hitting his numbers, but he never had a problem with investors telling him, we're going to fire you, or
I think we have time for, in fact, one more. In fact, I might steal it and prime the. Can I do that? Go for it. Okay. I want to make sure we touch on the CASI theme here. So one of the things that's I think is important for students and younger generations is working on something that's kind of meaningful to them, right? And so, I'd seen in the ESG in the sort of green space, just surfeit of people coming in who were really passionate about it. One of the things that strikes me as interesting in the last 20 years is a lot of the new industries that are being funded. It's hard to it's hard for me to understand how there's any social value, right? With some of the crypto stuff, you know, the VC funding by Jules, social media, it's that questions. I'm just curious, when you look at this space, how do you think people should navigate that? Number one. Number two, how do we think about how to fix that overall? Is that something that is culture of the industry, right? Is that you know, lack of government involvement at the right levels? These are big questions, but how would you approach that if you're someone sort of looking at getting involved in the industry, but you also want to, you know, sort of align with the businesses that if they double in size, they're good for the world, and we all kind of know that.
So it's a complex question, but let me see if I can break it down. I would say really special companies have 3 attributes, not 2. So the first one, at least in my world, companies are working with, you know, and working with the most interesting technology attracts the best talent. The opportunity you're working on, if it's successful, has real financial opportunity to do something extraordinarily valuable. And if the first 2 are true, it does something truly impactful in the world, you have the trifecta. You can suddenly convince people to quit perfectly good jobs to come do something that is actually more important. And I think it's very difficult to find companies that actually hit all 3 of those in equal measure such that you can attract really extraordinary people to those problems. So that's maybe the first one. The second thing, and this is something, you know, having been at Stanford now for almost 18 years, one of the things I observe in teaching the class that I do is I think passion is a term that we use ineffectively. I think there's a lot of students that somehow conflate passion with opportunity, or somehow believe that, you know, the thing that they, you know, their hobby is the thing that they have to do. I just tell you, I mean, like my first software company was an accounting software company. I did really well in undergrad, and I think I got a B in accounting. I loved building software. Actually, my wife's a CPA. I love my wife. I loved building software. I loved winning in the market. I loved building a team. I loved having customers use my product. I was passionate about what we did. I was passionate about the people who worked in that company that went public, who bought houses, put their kids in college, bought cars. You can be passionate about doing something extraordinary that changes people's lives in ways that are very different than the way we throw it around. It's much more personal. And I did, in each of the companies I did thousands of people that worked in those companies. And I'm proud of the impact that it had on each of them and the customers that used it. So one of the things I try and impress upon the students that come through my class is to take a much broader, more nuanced perspective of what you can be passionate about. Otherwise, you are limiting yourself. You will be limited by the few things that you think in the back of your mind are the things that everybody wants you to do, as opposed to the things you can do. So I think you should view this as a catalyst, not as a vectoring mechanism.
Wise words. Would you add anything, Russ?
Wow, it's a complicated topic. To wrap in a minute is, I mean, look, I think the venture capital industry is embedded in the capitalist market that we love and also hate, or let me say, love and see limitations to. And I don't think it's a question of somehow reforming venture capital. It is what it is. The question is, do you want to regulate it in some way? And that's a big question. How would you regulate it? I don't know. I mean, again, the industry thinks, well, we'll tell you that it's the best at allocating capital for the kind of innovations that we need in this country and in the world. There's some truth to that. If you look at the big companies, the most innovative big companies, they're usually funded by VCs. Not always, but like overwhelmingly the case. Studies have shown that. So there's some truth to that. But are there excesses? Yes. Are there perversions, distortions of the market as a result? Yes. So do you want both? I don't know. Can you limit one and still get the other? These are tough questions.
That sounds like the broader question around capitalism in pretty much every market I'm seeing right now.
You asked. I tried to answer.
We need them, but not exactly like this version of it. Well, that's a good note to finish on. Thank you to our amazing panelists for sharing your time and experience. I think it was very exciting. In fact, I heard it was the best one ever. I'm going to paraphrase that, but honestly, very, super helpful, because having been an MBA student myself, and you guys also know, there's a million things you learn only the hard way when you get out there. So hopefully you've, I think, saved a lot of folks here some time and heartache by learning through your experience. Thank you.